The 7 money formulas of business that can 80x your net worth. I know that these 7 formulas, these 7 principles are what allowed me to 80x my own net worth in a couple of years' time. And I'm going to be breaking them down step by step. These have been years and years of painful lessons in scaling my own company that I'll be giving to you right now. The concept is really about financial excellence. I think the biggest thing that business owners struggle with, especially once you've cracked the growth code on how to grow your top line revenues, is how do you keep the bottom line in check, and how do you understand how to manage your finances effectively, even if you are profitable in your business, because oftentimes the companies that are profitable become fat and happy and end up wasting a bunch of their money and missing out on so many different opportunities. So we'll also hit into some of the pain points around, when you increase your income, you increase your tax bill, some insights around that. I'm going to start with really the first principle around hiring financial help and why you actually get paid. It's not an expense to hire financial help. You actually get paid when you hire the right financial help for your law firm. So in this episode of the Law Firm Growth Acceleration podcast, we're going to dive into this. So 2022 was a crazy year for me. We had made top 600 fastest growing company in the entire United States, according to Inc. 5000. The year after that, we got top 700. I was feeling super pumped. I was screenshotting Inc. 5000 and showing people, my company was one of the fastest growing companies in the United States. And yet deep down, I was in a really painful place. Many people don't know in 2022 that my partner Andy and I, we had to wire personal funds to our business bank account in order to make payroll. The year after 2022, we did 1.63% profit. The year before that, 2022, we did 3.29% profit. So I knew something wasn't working, and I realized that our bookkeeper wasn't giving us strategic financial insights. And I didn't really have anyone to own this problem for us and really, take over the financial problems that we were having in our business. So even though our company profited 1.63% in 2023, the last thing I was thinking about was adding to the crazy amount of expenses. Now, mind you, 2023, our company collected around $18 million in revenue, and we only profited like $300,000 on that. So I was thinking, how am I going to solve this problem? I probably got to hire help. I got to hire someone to bring in as a VP of finance for our team to start owning this problem. And that was going to cost us anywhere between $10,000 to $15,000 a month. So that right there was cutting into our profits even more. So we're going from profiting $300,000 a year to then if I hire a VP of finance, it's going to cost us another, call it $200,000 a year, which puts us even more in the red, right? So in a state of basically frustration, we put up a job ad and I said, well, screw it. Worst thing that happens is we have to wire money to the bank account again and we run out of money. But hopefully I can hire someone to help us solve this financial problem. So we did. We hired our VP of finance and data. It did temporarily reduce our profits. And what I realized as soon as I hired this person was part of the reason that we were in such a financial situation was because our books were not categorized properly. Our profit and loss statement was not legible. We had sales and marketing expenses labeled in the wrong categories. We had operating expenses labeled in the wrong categories. I didn't even know what these categories were at the time. So when I look at our profit and loss statement, it didn't tell a story. There was really nothing to look at. I mean, it was confusing. It was impossible to make strategic financial decisions on where we could save money and cut costs. and even make more money from our current investments. It all was not clear to me. So what happened was this new VP of Finance, Kevin, and our COO, Brandon, I basically texted them and I said, we are not going to step foot into our office, which I'm in right now. We're not going to step foot into our office until this problem is solved, starting with the milestone step of our profit and loss statement is going to be crystal clear. We're going to know exactly where our money is coming in by source, where it's going out by expense source. So instead of showing up to the office for 3 days straight, we ended up showing up to my house, my personal residence, for 3 days straight, so that there were no distractions. We put all of our financial paperwork out on my kitchen table, and we went line by line through every single expense in the company. And as you can imagine, in an $18 million company, that was a lot of lines. There were a lot of expenses, a lot of vendors, a lot of things we had to work through. And we showed up day 2 and we did the same thing, worked at the kitchen table all day. We showed up day 3, we worked at the kitchen table all day. And by the end of day 3, we started feeling like, okay, our profit and loss statement is finally clear. So we go back into the office after this 3rd day at my kitchen table, and we finally have financial statements that make some sort of sense, right? We started understanding, how much money we were spending on this section of the business and how much we were actually spending to acquire a customer, and how much we were actually spending in total sales and marketing spend when you combine all of our sales team salaries, all commissions, all marketing spend, all marketing team salaries, everything combined. So there was a lot of very powerful data that came from this, and a lot of it was negative. And the insight was we were spending too much money to acquire customers, and we were spending too much money to deliver services to customers, which means we were undercharging, right? Or we had bloat in our expenses. But the beautiful thing was we finally knew our cost of goods sold. We finally knew how much it was costing for us to sell our services. We finally knew our net profits. We finally knew our gross profits. We finally knew our sales and marketing expenses, finally understood our operating expenses, otherwise known as overhead. So we put in a plan and we said we were going to go from profiting $300,000 in 2023. We wanted to profit over $2 million the next year. And that is an unheard of leap in profits, especially when you're a growing company, because that next year, we grew our company significantly by multiple millions of dollars. We ended up growing our company, I think, somewhere around 50% year over year at that revenue level. And yet we still wanted to profit over $2 million that next year. And we didn't profit $2 million that next year. We profited $2.2 million. And it was all the seed planted from this 3-day session at my kitchen table and the hiring of this new VP of Finance who really owned our financials going forward. Fast forward to this year, the following year, we're on track to be profiting over across our companies, anywhere between $8.5 to $10 million in the next year, in 1 year. And all that progress comes from this cleanup that happened and the quality decision making that was able to stem from it. So now I look back at where we are now. I look at our valuation as a company and I realize when we were doing $300,000 in profit, our company wasn't really worth shit. It was worth nothing. But when we got the $2.2 million in non-adjusted profits, non-adjusted EBITDA, our company's valuation easily 15x. I mean, or even just 10 to 15x, right? Huge lift in the value of our company by solving this problem. And I look at how much I had to spend to hire this VP of Finance, and at the time it felt like such a risky move because we already weren't profitable. And I realized this is one of the single best decisions I ever made, was investing to have the right partner to help us solve our financial problems. Now, the next problem that occurred was once we hit the 2.2 million in annual profit mark, which we're now well beyond, the tax bill that occurred as a result of this. As a pass-through entity, which most companies are, if you run an LLC, um, or you run a partnership in the United States, uh, most companies in the U.S., unless they're C corporations, are pass-through entities, which means you pay taxes on the business's earnings personally based on what percent of the company you own. Um, so if you own 100% of your company and your company profits $2.2 million, you have to pay taxes on those $2.2 million, which is a new problem. And if you're at a high income bracket, you have to pay for me, I have to pay around 41% of my income in taxes. So then the problem became, okay, I, you know, if I'm taking 41%, if I owe 41% of my share of the company's profits as taxes, then I have to distribute to myself at least 41% of the company's earnings so I can cover my tax bill. So by distributing 41% of the company's earnings, I'm basically breaking even with my tax bill, right? Which means I'm making no excess income from my company, right? So then this is a news flash. And then I start looking at our bank account at the end of the year and I'm realizing, we profited all this money, but where the hell is the money? Where the money's not in our bank account, right? So then we got really clear on cash flow forecasting. Once we got our profits cleaned up, we did that cleanup, then we got clear on, um, you know, the timing of our cash inflows and outflows, right? And we started creating predictability around that so that we were able to see that bank account consistently grow month over month over month without that uncertainty as to like, where is all this profit going? If we're so profitable, where is it going, in our business? And at that time, we weren't even that profitable. I mean, now I'd say we're approaching the quite profitable category. So what we realized is that a bunch of our clients who work with us as law firms had very similar problems to these, especially when they grew. Their profits plummeted. They had no one in charge of their profits. And they also were not able to mitigate tax bills. They weren't clear on their cash flow forecasting. And that ultimately ended up becoming the birth of our division within our company called Precision Profits, which is our fractional CFO and bookkeeping services, which we offer to law firms. So long story short, I realized that I got paid to hire someone to help me solve our financial problems in our business. And yes, I may have outlaid $10,000 or $15,000 a month, but the amount I got back in enterprise value and valuation of our company is tens of millions of dollars. So it's one of the best deals I've ever made in business, is hiring financial help, right? And for most businesses, hiring a full-time in-house finance employee is cost prohibitive, hence why it's vitally important that people find fractional CFOs and high-level bookkeepers, not number crunching bookkeepers who can direct your financial allocation strategy rather than just be a victim to whatever expenses and incomes pop into your statement. So that was one of my biggest first lessons, was that it does not cost money to hire someone to help you with your finances and your business. It actually is probably the biggest money printing machine decision you could ever make. The second pillar I want to share is the financial levers that I learned work for every practice area of law, and really at every business, in the process of dissecting my financials. These are the things that added multiple seven figures to our company's annual profits when I started understanding these. Number one is average fee versus cost of goods sold. This is what I call holy grail number one. How much does it cost per unit of revenue for you to deliver services to your clients? Okay. A lot of law firms are doing more work than they bill for. Okay. A lot of law firms are collecting too low of an average fee per client, right? And a lot of law firms also do not have a salary cap, right? They just hire whenever they feel busy. They don't operate to a salary cap like a sports team does. So I started analyzing average fee per client versus the cost of delivering service to those clients. And I realized There were parts of our business we were overstaffed, and there were parts of our business we were understaffed, right? So we had to balance out this ratio so that every client that comes into our company, we're not spending more in money than we are making from them. But not just spending more, we need to be making at least 3 times the cost, right? Which gives you a 67% gross profit, which is the holy grail. Where let's say you let's say that you your average fee per client is $10,000. You'd want to cap the amount you spend on any one given client at $3,300, because $3,300 times 3 gives you a 3x quote unquote markup and puts you at a 67% gross profit. So of that $10,000, your gross profit on services delivered is $6,700, which makes your gross profit 67%, right? The biggest mistake I see people make, like I said, is they either are charging too little or they're doing too much work for clients for their fee. So let's talk about both categories. Let's talk about the doing too much work per fee. So let's say law firm A, each attorney in the law firm's billable hourly rate is $250, right? And let's say your average fee per case is $10,000. Well, if your billable hourly rate per attorney is $250, and it takes an attorney an average of 10 hours to handle an entire case from start to finish of billable hour time, then your cost would be $2,500 and your income for that per client basis would be $10,000. You'd be perfectly fine. You'd be at a 75% gross profit, and you are not going to have problems scaling a law firm if you're at 75% gross profit. The big caveat here to watch out for is sometimes if the law firm owner is doing all the legal work, it disguises, the company may look profitable, but it's disguising the fact that you have nobody else to do the work, and therefore there's no additional hourly rate associated with additional staff members doing the work, which is why I always say the worst thing you could ever do is take an unprofitable gross profit law firm and scale it, because you're just going to become more and more and more unprofitable as you bring on more and more clients, unless you fix your cost of goods sold or unless you increase your average fee. So, but we know how it doesn't really work like that, right? It's not just like one attorney does 10 hours of work on a client. You have support staff who also does some client work, right? You have other expenses that tie in that are directly relevant to the case revenue, right? So you've got to add up every single cost to really know what your cost of goods sold is, right? And then on the average fee side, we have to make sure we're not charging too little, okay? If another law firm in your market is charging $8,000 per DUI, right? And you're charging $5,500 per DUI because you convinced yourself that you'll price yourself out of the market if you charge any higher, then you've got to re-question that belief. Because if somebody else is doing it in your market, I'd rather study how they're doing it and make an unequivocal decision to increase my average fees rather than put my tail between my legs because I'm unable to solve the sales process problems that would need to be solved in order to predictably get $8K per DUI. And this applies to every single case area, practice area. In personal injury, this comes down to the quality of cases you take on and how you work those cases, right? One of the best ways to increase average fee as a personal injury attorney or contingency fee is to just get better outcomes for your clients, right? With the constraint of time on desk, right? Because if it takes you 15 years to get $1 million settlement for a client, that means that client has to wait 15 years before they get any money. That client may be better off getting $500,000 for their case if you can get that case resolved in 12 months versus 15 years, right? It also may be better for your firm just from a time value of money perspective. So not all settlements are created equal based on the time it takes to get those settlements, right? So there's a trade-off and there's that artistic balance around size of settlement and speed of settlement, right? And we ultimately want to do what's in our client's best interest. So understanding how to work cases better to get bigger average settlement amounts while applying a constraint to how much time is invested in the case is the art of running a profitable personal injury practice, right? So your average fee is based on what types of cases you sign up, what fact patterns sign up with you, and then at the same time, how well you work your cases. And both of these things are controllable. The types of cases you attract are controllable through your branding and what lead generation campaigns you do, controllable through optimizations to your intake process. So average fee, whether it's contingency fee-based firms or flat fee-based or hourly, whatever your firm is, the average fee per case is a controllable metric, just like the average cost of goods sold per case, right? So this ratio of average fee versus cost of goods sold being at 67% gross profit is the first lever, right? The second financial lever is what we call cash flow consistency. Okay, this is holy grail number 2. So, at our company, we practice what we preach in our finance teachings. We bill upfront and in advance for everything. We have almost no accounts receivable. Okay, so cash flow is very different than profits, right? You could bill someone $100,000, but if they only pay you 20 grand, then that $80,000 sitting out there on the street is going to become a huge cash flow constraint for your firm. So I always say, instead of reactively trying to get back some of your past accounts receivables, we want to craft a pricing strategy or a billing strategy where we never have accounts receivable, right? So taking a big payment and breaking it out into monthly recurring payments so that your client can make each of those payments. Finding a way to get higher upfront deposits for the initial sign up, and creating a method to where accounts receivable is never a problem, right? That's step one. Once it's become a problem, okay, we can do some reactive measures to try and collect on some of our accounts receivable, but it's always harder to collect after they haven't paid than it is to collect at the point of sale and to go through the communication needed to solve that early in the client relationship rather than after the case is done, for example. And cash flow consistency for a contingency firm comes down to the inability to predict settlements and time on desk, which we previously talked about. The best PI firms and contingency fee firms are able to predict down to the nth decimal point when their cases are going to settle and for what amount on average. And they know this with a certain degree of certainty based on historical data. So they're never wondering when settlements are going to hit, right? Because they're applying an algorithm of sorts to past data and then comparing that to future signed cases. So cash flow consistency is mission critical to solve in terms of eliminating accounts receivable and being able to predict when settlements are going to come in and the time at which they're going to come in and the amount at which they're going to come in. So cash flow consistency, cash flow consistency. Okay, that's holy grail number 2. Average fee per cost of goods sold, which is really your gross profit percentage. Cash flow consistency number 2. Number 3, sales and marketing efficiency. Okay, this is holy grail number 3. Okay, the key in sales and marketing efficiency is you never want to cut sales and marketing costs if you are a growth-minded law firm owner, right? Instead, it's about efficiency. It's how do we keep spending what we're spending now? This is assuming you're already spending, right? How do we keep spending what we're spending now or more and get exponentially better results per unit of spend? That's sales and marketing efficiency. So this comes down to your average fee per case type versus the cost to acquire that case type. Let's say one case type you handle, average fee is 20 grand. You should be okay with spending, 3x on your cost of acquisition. So you should be okay with spending $6,500 to acquire a $20,000 fee, right? That's a 3x return on marketing spend. That would mean your cost of acquisition again is $7,000 or $6,500, and your average fee is $20,000, right? That's good. But for cases that have an average fee of $2,000, right, you can only afford to spend somewhere around $670. right? To acquire a case that's fee will only be, $2,000 average fee. So there's a spectrum, right? Your lower ticket average fee cases, you're going to have to be extremely efficient in how you acquire cases for low average fee business units. And then separately, you can be a little bit more an approximator when you're doing it for the bigger average case types, because it doesn't have to be a perfect science, but you also have so much more wiggle room on how much you can spend to acquire one of those clients, right? So we have cost of acquisition as a whole, right? CAC, as other people call it, as we call it. So we take all of our marketing spend, all of our intake team spend, all of our marketing team spend. So this is marketing team salaries, sales team salaries. If you have a bonus plan for your intake team, and all this spend, whether that is marketing vendor spend, okay, and or marketing ad spend on the advertising platforms, all of that added up is your total marketing expense for the year. Divide that by how many clients you signed up total that year, and that is your overall law firm cost of acquisition, right? And I love calculating it from the zoomed out perspective first, then drilling into niche specific campaigns that you have to target specific case types, right? Another sales and marketing efficiency measurement is your sales cycle speed, right? This basically comes down to how do we speed up the sales process, right? If it takes you a week or a month to take someone who calls your firm to turn them into a signed client, we want to cut that in half. We want to cut that by, as much as we possibly can cut it, right? So that our sales cycle is faster. If we're signing cases on average 3 days from when they reach out, we want to cut that down to 1 day. So not only do we need to be efficient in our spend, we have to be effective in the rate and speed at which we sign up clients, right? And when you do all these things, you build what's called sales velocity, right? Which I like to combine two things into sales velocity, which is the frequency at which you make sales, okay? But also the sales cycle, how long it takes from when someone reaches out to you to when they actually sign up with your firm. And then if we add a bonus on top of this, it would be, how all of your sales and marketing spend ties into your average fee by case type, right? Which I've talked about before. So, understanding I'm okay to spend more for this case type, I want to spend less for this case type, right? So the financial levers that work for every business is, average fee versus your cost of goods sold, dialing in cash flow consistency, and dialing in your sales and marketing efficiency, right? We have a client who runs this really big firm, uses our CFO services with us. This client is doing a $6,000 a month CFO package with us. And so we analyzed their books. This firm's already profitable. They're spending $750,000 a month on marketing and intake spend. And they were signing up 142 cases a month. The cost of acquisition was around $5,000. We looked at this. We saw some lead sources they were getting for $3,700 cost per case. And we implemented that across other parts of, we made a recommendation from our finance team to implement that insight across the things that were getting them $3,700 cases across their whole firm, and their whole firm's cost of acquisition went from $5,000 down to $3,700. And that added an extra $1.48 million per month in revenue from this one shift. And most of that revenue was profit because it was on a sunk cost of spend. Another example of how hiring a financial expert to help you with your business never costs you money if it's done right. The other thing that I thought through is, why does everybody have the time and money to make this shift? And it ultimately comes down to how to 80x your net worth. So when I learned how EBITDA multiples work, net profit multiples work, it was like one of the wonders of the world for me. I learned that when a business profits $1 million a year, it might get a 5x multiple on profits in terms of if you were to sell that business, right? If a company makes $2 million a year in profit, it might get a 7x multiple. If a company profits $4 million a year, it might get a 10x multiple, right? If a company profits $10 million a year, it might get a 12 to 15x multiple, depending on what industry you're in, right? Now, law firms tend to get lower multiples because they're not recurring revenue businesses. But here's the crazy thing. Let's say your firm's profiting $1 million a year right now. Let's say you get a 5x multiple on that. That means if you sold your law firm's worth $5 million. 5 times 1, right? Your EBITDA multiple would be a 5x. When you get the 10 million in profit, your multiple goes, anywhere between 12 to 15x. So just by growing your net profits, your multiple can increase in this example from $1 million, from a 5x multiple on $1 million to a 12x multiple on $10 million. So that means if I sell a business that's doing 10 million in profits, that company is probably going to be worth, at least in my industry, because I know the comps in my industry, that company is going to be worth over $120 million cash, right, as a sellable asset, right? So you get paid so much more money when you can get your business extremely profitable and to that $5 or $10 million net profit mark. Most businesses never, ever get there. I know for me, when my company was profiting $300,000, we got a very low multiple. I think my company was probably worth $1.5 million then, even though it did $18 million in revenue, just because of how low the earnings were. And now our company's on track in the next call it 15 months to be, worth well over 9 figures, right? So I personally, from this one insight around EBITDA and net profit and all these financial disciplines and lessons and levers we put into place, I personally 80x my net worth. And that's why everybody has the time and money to do this, because literally if your net worth is tied up in your business, your entire enterprise value as a person ultimately comes down to you solving these financial equations. So my 7 key lessons are: number 1, you get paid to hire the right CFO and bookkeeper. It is not a cost. Number 2, you have to have your expenses categorized properly to make the right decisions, and your revenues categorized properly. That profit and loss statement should be so damn clean, so well understood by you, so you can gain that X factor, that spidey sense of when you're spending money in the wrong areas in your business, and not just look at some, profit and loss statement thrown up against the wall that confuses the hell out of you. Number 3, you have to get your average fee versus cost of goods sold right. Your gross profit. This is the cost to deliver service per average fee. Number 4, you have to create cash flow consistency in every single part of your business. Eliminate accounts receivable. Know exactly when and what dollar amount settlements will hit your bank account. Control time on desk. Number 5, ensure sales and marketing efficiency, not cost cutting. How can we spend what we're spending now or more and get exponentially more results from either what we're spending now or a slight increase over what we're currently spending if we're not spending enough? But I always look at sales and marketing. If you want to grow your enterprise value as a business, if you want to grow your net worth, you got to increase your sales and marketing spend over time so you can acquire more customers, especially more profitable customers, and grow that bottom line number. So sales and marketing efficiency is the key, not cost cutting. Number 6, understand the mystery of EBITDA multiples. Understand that when you increase your net profits, your business's valuation will exponentially increase, because you can take your business from a 3 to 5x multiple to a 10 to 12x multiple over time once you get to a certain level of net profit. And number 7, understand 100% of your net worth and take-home income depends on your company's profits, right? If your company profits nothing, it's worth nothing for most investors. Now, you could get a strategic investor who will give you a speculative investment amount on top line revenue, but you don't want to leave your entire net worth up to chance and up to a speculative investment. Most surefire way to grow your net worth is to grow your bottom line profits while sustaining a reasonable growth rate, right? So, yeah, these are the lessons that transformed my financials. You shouldn't be doing all this on your own. That's the biggest lesson I've learned is when I was doing this on my own, we ran out of money and I had to wire money to my company's bank account. Now I don't do this on my own, right? We have new bookkeepers. We have a in-house CFO that follows the exact process we use for our fractional CFO clients for law firms. And that's why we invented Precision Profits. So Precision Profits, our bookkeeping and CFO company, what we've learned is that in order for a client of ours to get benefit from our CFO services, the books have to be clean. So what we do is first if you ever reach out to us to talk about this, we're going to first analyze your financial statements to see, do you have an organization problem? Meaning, are your financial statements messy and illegible and categorized properly or improperly? That's step one. Then we look at the intrinsic nature of the actual books. What are the books telling us? What's your profit and loss statement? What's the story of your law firm's financials? And then it's a balancing act, right? It's, do we want to start by first getting you on bookkeeping to clean up your books so that you can be crystal clear on where your expenses and revenue sources are? Or do we need a CFO to get in there and make corrective changes, right? And if you have a bookkeeper that you work with, what some clients of ours do is they hire a CFO from us, and that law firm CFO works with your current bookkeeper to organize everything properly. Or, some firms aren't ready for a CFO, and instead they do bookkeeping with us, and we do all the organization for you. We actually give you financial account manager hours on our bookkeeping packages, so you can have 2 hours a month of meeting with the bookkeeper to go through your financial updates. But what we intend to do with Precision Profits is we want you to know your numbers with clarity. We want you to have a clear pricing strategy. We want you to allocate payroll properly. We want you to be able to permanently solve your cash flow and profit volatility. We want to solve your accounts receivable process and leaks. We want to give you clear reporting. We want to help with compliance risk and, if you have trusts and stuff like that. And the key is we understand growth-minded financials for growth-minded attorneys. So if you're serious about your financial future, I highly recommend, please don't go through the pain that I did. Whether it's us, whether it's you finding a new bookkeeper other than us, I don't care. What I care about is you permanently solve your damn financial problems. And if we can be of help to you on your growth journey, then, reach out to us on SMB team. And if not, go find someone who can give you the financial insights that you need to take your business to the next level. Your net worth, quite frankly, depends on it. So those are my biggest lessons around, creating financial excellence in a law firm. A lot of the lessons learned through my own scar tissue, and I hope that you can implement these into your firm rapidly to never run out of money and, also become rich. That's pretty cool, huh? All right, I'll see you in the next episode. Stay great.